CME Group is launching Micro E-mini futures contracts. Discover how a smaller Micro E-mini futures contract opens the world to greater trading possibilities.
Welcome to Striking Option, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Bob Icino. Welcome, Bob.
Really happy to be here, Jeff.
Well, it's really interesting. These trade tariff conversations, they remain front and center. Where are these markets headed, Bob?
Well, I don't know if I know where they're headed, but I definitely know that we've been talking about this, you and I, for quite a while, that even though the talks seem to be going well, we don't have talks in place. The risk of that proved out this week.
Well, I think that's what the market is raising an eyebrow right now. Are these negotiating tactics, or is the administration, the U.S. administration, willing to walk away from these trade negotiations?
Yeah, and I think that's still a question. We'll probably find out later in the week. Friday, May 10th is a big target for those talks.
All right, we'll be waiting to see on Friday, May 10th. Let's get this first lightning round if you're ready, Bob.
I am ready.
Oil volatility. Well, we certainly have seen the correlation between crude oil and the equity markets. We're seeing a lot of volatility come out ever since we did see that tweet on Sunday night about these trade tariff conversations. But what are your thoughts on crude oil? It essentially seems a little bit range bound despite the volatility.
Yeah, range bound is a good phrase for it. I am signalless right now. I don't have a trade signal. But I still have some fears about sort of the geopolitical tensions which seem to be escalating with the U.S., Iran, and Saudi Arabia.
Well, that's really interesting. We talked about the geopolitical tension could ramp up very quickly. So what type of trade example would you potentially utilize to embrace that geopolitical tension?
Well, if it does ramp up, we could see a spike. So what I'd like to look at as an example is buying the week 3, May 66-68 call spread in crude oil. That means I'm buying the 66 call for about $100 when we price this out, and I'm selling the 68 week 3 May call for $40. The buying of this call spread would cost an investor about $60 per contract. This call spread expires week 3, about May 17th.
That's fantastic. And the June futures was the underlying future contract, trading around 61.43 when this trade example was priced. It was interesting that at the money volatility, back over 30, right around 31.5. And we talk a lot in striking options about wanting to be a seller of higher premiums. But in this situation, when markets can turn on a dime due to geopolitical tension, we're actually being a buyer here of this premium, correct?
Yeah, if this tension were to ramp up to a level that would spike oil, we can't predict it. So this is one where I want to participate. The $60 risk doesn't bother me.
And you define your risk by using options on futures. Great stuff, Bob. And please remember that these are trade examples, not trade recommendations. Let's move into the second lightning round.
Let's do it.
Resiliency. Well, we certainly did see some resiliency in the market yesterday, but there's a lot of volatility. And one of the things we get really excited here at the CME Group is about this micro launch. We saw that Sunday night, right, Bob?
Yeah, there was record volume for a contract launch. The liquidity was there, in part because of the president's tweet. You were actually able to see how this product worked.
Well, the trade example I want to talk about today is utilizing the Micro E-mini S&P 500. And to understand that, one E-mini S&P 500 is equal to 10 micros. What's really exciting about this is I looked at the market this morning at that 29.17 level. By selling 10 micros there, that hedges and mitigates risk to the downside in the event we go back and test that Sunday night low at 28.83. But can you walk us through the advantages of utilizing a micro, a more precision type of hedge?
Yeah, the active individual trader now has a choice, not only of product, but of size. And what I mean by that is if you're hedging a portfolio with the CME Group products, you now don't have to make the decision to take an entire hedge off. In Jeff's example, you could actually scale in and out of your hedge. So as the market comes back and your portfolio produces, you could take a little off, keep part of the hedge on.
And that's super exciting. And just to do the quick math here, if you look at the price of the E-mini S&P 500 at 29.17, you times that by $50, which is the tick value, gets us to about $145,000 roughly of notional exposure. By selling 10 of those micro E-mini S&P 500s, you have the ability to feather in that risk mitigation, and every one micro you buy back in is essentially establishing 14,500 of exposure. Is that right, Bob? Did I do my math right there?
Yeah, that's absolutely right. And again, as the market comes back, you may end up with only 5 micros on. As it goes your way, meaning the hedge, your portfolio is still damaged, you could theoretically take some of that off and take profits on the hedge.
And you can use limit orders and micros underneath the market, so if the market does move again over some type of tweet or some other volatility moving in the market, you have those abilities to have those orders working nearly 23 hours, 23 and a half hours a day.
Yeah, I think your example of calling it a precision tool is a really good one.
All right, Bob. Well, thanks as always for coming on. I want to thank you for tuning in to Striking Options. And please tune in every week as we will continue to strike options.